Okay, so we are discussing about the different type of risk in the financial system. So, in the previous class we discussed about the the different type of systematic risk what the system always faces, and what are those different type of systematic risk we have, like your market risk, you have interest rate risk, you have inflation risk, you have the exchange rate risk, you have country risk, etc., etc. Then today in this session we will be discussing about the different type of unsystematic risk. And already I discussed with you that unsystematic risk is nothing but the particular risk which is specific to the particular individual or particular entity. It may be an individual, it may be a corporate sector, or it may be anything, but it is may be related to, it may be any kind of organization, any kind of entity who are participating in the system, but mostly this risk is confined to that particular entity and it does not affect the others. To some extent, we are telling that this particular risk is defined as the unsystematic risk. And other name of unsystematic risk is it can be diversified. Already I explained to you that if any investor can have the varieties of assets or varieties of kind of instruments in their portfolio, then they can diversify the total risk, because if one particular asset or one particular instrument is not doing well, then the other instruments can basically make up the loss what they are making by creating certain kind of profit or certain kind of return with respect to that individual asset. So, therefore, unsystematic risk is a very important concept which is used in the investment or the portfolio management process, and as well as it is also very plays a significant role in the financial system participation as a whole. So, then let us see that what are those different type of major type of unsystematic risk always we have in the financial system. We have business risk, we have financial risk, we have default risk, we have liquidity risk, we have the maturity risk, we have the call risk. Here I have given a list of the different type of major type of unsystematic risk what the always financial system witnessed, or where we always we find this kind of risk prevails in the system as a whole. But there may be other type of unsystematic risk which is specific to the individual company or individual entity, but here if you see that these are the major type of unsystematic risk always we face. So, one by one if you discuss that what exactly those type of unsystematic risk are defined and how this particular risk are playing the role for the investor to maximize or maximize the return or minimize the risk. So, let us see what do we mean by the business risk. The business risk is nothing but it is the uncertainty of income flows that is caused by the nature of a firm's business. In a very raw sense, I can tell that business risk is nothing but the fluctuations of the sales income of that particular company. If the sales income is fluctuating highly, then we can say that particular company is exposed to more business risk. And if the fluctuations of the sales is relatively less, or the deviation of the expected sales and actual sales are less, then we can say that the business risk of that particular company is less. So, here what we are trying to say that business risk is nothing but the volatility or the standard deviation of the sales income of that particular company in a crude sense or in a quantitative sense. That is the way we can define. So, that is why the major income flow what the company gets, that is basically from the sales. Actual definition is it is the uncertainty of income flows that is caused by the nature of a firm's business. So, how this business is getting fluctuated, how the business is getting affected, that is basically always derived from the fluctuations of the sales income of that particular company or particular firm. So, it has two components. one is internal, another one is the external. So, here that means what you are trying to say, there are some internal factors which basically plays the role for deviation of the sales or fluctuation of the sales, and another factor, there are some external factors also which contribute the fluctuations of the sales of the company. Then what are those internal factors? The internal factors related to the operating efficiency of the company, how the company operates, what kind of business strategy they adopt, and how the sales basically or sales maximization strategy the company is going to follow, and what kind of structure they have, what kind of strategy they are making to sell their product in a better way, what kind of advertisement strategy they have, and how they can make their customer base, how they can make their product differentiation in such a way they can beat their competitors, etc., etc. These are coming under the internal factors. But whenever we are coming to the external factors can be the cyclic conditions, the seasonal conditions. For example, if one particular company which is selling these cold products like cold drinks, ice creams and etc., obviously their sales income is highly fluctuated by the seasonal factors, because in some seasons the sales figure basically is quite high, in some seasons the sales decline. So, because of that there are some external factors which contribute their fluctuations of the sales. So, that is nothing but related to the strategy which they adopt internally, but mostly those places the factors are mostly determined by the external factors. But mostly if the company's internal policy is affecting the sales income, then the company is more exposed to the business risk, because this seasonal factor and the cyclical factors can be predicted to some extent, because this is a periodical occurrence or periodical things which is happening to that particular company. But whenever something is going wrong to the company, because of that the sales is declining and which is happening in internally, then that is a more worrisome matter for the company in comparison to the other external factors which contribute to the fluctuations of the sales. So, but the external factors is not in the control of the company, but the internal factors can be controlled by the company in a larger extent, and it is basically we can say that affecting the company in a the internal company should be controlled, by that the business risk should not arise from that. So, that is the basic objective should be the company always have. So, this is already told you that the business risk is measured by the distribution of firm's operating income, that is firm's earning before interest and tax, that already you know that EBIT, and here I have talked about the sales in a crude way, but EBIT is basically what before whatever profit the company earns and how the profit gets affected, and profit is obviously is dependent upon the income what the company is generating out of the selling of that particular product what the company is producing. So, this is what basically the business risk talks about. Then we can see that another thing, another risk which is called the financial risk. You see, whenever any company tries to invest in the market, what they do? They basically wants the company want basically money. If the company wants money for that or capital for that, what is the source of capital? The source of capital is either they can raise it in terms of debt or they can raise it in terms of equity. So, that is every company has a debt component and the company has also equity component. But here in the finance literature, the financial risk is measured through the debt financing. That means, what here we are trying to say, if the company's debt is more, then company is exposed to more risk. If company's debt is less, company is exposed to less risk in terms of which is defined as the financial risk. That means, what is the percentage of the capital are financed through debt and what is the percentage of capital which is financed through equity. If the percentage of the capital financed through debt is quite high in comparison to the percentage of the capital financed through equity is quite high in relation to finance through equity, then we can say that the financial risk of the company is quite high. So, therefore, we say that if the debt to equity, debt to total capital is high, then the company is exposed to more financial risk. Why? Why you are saying that if the company's debt is more, their financial risk, they are exposed to more financial risk, or the financial risk of the company is more? Why is it so? Why that particular thing basically always we assume? The reason is basically, you see, whenever any company has taken the loan or company has issued the debt or the bonds. So, in that particular point of time, the first basic obligation of the company is whenever they get the profit, they have to pay them, and it is fixed, you cannot avoid that. You see, already I told you that your capital is debt and you have the equity. Equity means whenever you have raised the money from the public in terms of the stocks. And if you have taken the loan or you have issued the bond against that particular issuance, whatever or money whatever you have raised from the market, then after a periodical basis, every periodical basis, a certain amount of interest has to be paid. Interest payments has to be made. So, whenever the company has let a total profit, once company gets the profit, the first is first of all the company has to pay the interest, because for the loan, for the bond and everything, interest payment has to be made first. Then total profit, and after that company will pay the tax. Then after that, if company wants, they can pay the dividend. Then whatever remaining will be there, that is called the retained earnings. But here the issue is, company may not pay the dividend to the equity holder. Most of the company also do not pay the dividend. But if they have the debt component, then obviously there is a fixed obligation for them to pay the interest regularly. So, that is why the earnings of the firm may not be sufficient to meet the obligations toward the creditors. For example, the firm does not have much profit to pay the interest. Whatever the interest payments they have to make, company generates certain profit, but that is not sufficient. Then the financial risk increases heavily. So, whenever you talk about these things, another thing is, here if the company does not have much profit to pay the interest, and but still they are generating some profit which should be given to the equity holder, but company is not able to, even it is not sufficient to pay the debt holder, then what the company does, whatever remaining money will be there, they will pay to the debt holder, equity holder does not get anything. So, therefore, it increases also the conflict between the managers and the equity holder, and that conflict again increases the cost of the company, which again increases the risk of the company. What here we are trying to say? First of all, it is not sufficient, because of that the company is exposed to more risk, number one. Number two, whenever the equity holder feels that the company is generating certain profit, but that profit first of all they have to pay to the debt holders, and at the expense of, because once the equity holder does not get any money, so they are also basically annoyed, or they must not be very happy with the company. That is why conflict arises between the managers of the company and the equity holder, that again further increases the risk of the company, because equity holders may not be interested to invest in that particular stock in the future, and to attract them the company again has to give some more premium. So, in both ways the composition of more debt in the company increases the financial risk level of the company, and as well as the investors are relatively less reluctant, or they will be less reluctant because they will reluctant in the sense what we are talking about. The investors will be reluctant to invest in equity, but the company also will be always feeling that I have some fixed obligations, that is why my risk is more, and I have some binding role, and that role basically declines my operating efficiency. So, that is why the financial risk basically increases if the debt to equity ratio is high. Already I told you that higher the variability of or higher the ratio, higher the variability of the return, and obviously the financial risk is relatively higher for them. So, this is about your financial risk. Then we can have another risk which we call it the default risk or the credit risk. What exactly the credit risk or the default risk is? The default risk arises from the failure on the part of the borrower or the debtor to pay the specified amount of interest or to repay the principal both at the time specified in the debt contract. What exactly it means? For example, somebody has taken a loan, and in the loan agreement what has been mentioned, you have to pay the interest periodically and as well as you have to pay the principal at a particular time. But you assume if the particular entity or particular individual or particular corporate could not pay the interest or could not pay the principal, then what will happen? That it will increase the risk for that particular organization who has given that particular loan. So, here what the credit risk or the default risk is trying to measure? The default risk basically measures the probability of default. If I have given you the loan, then what is the probability that you may not refund that loan in terms of interest or the principal, which will increase the risk level of that particular company, because that particular default payment or default in terms of the payment will affect the performance of that particular company or profitability of that particular company. So, because of that, default risk is quite important. Mostly it is very important from the banking point of view, because banks are basically mostly doing the loan business, and their almost the profit analysis or profit scenario totally depends upon the amount of credit whatever they have given or amount of loans whatever they have given. So, therefore, what we can say that the default risk is quite important from the financial institutions point of view, because it basically measures that what is the probability the money can be repaid, the repayment can be made. So, that is basically we measure it at the default risk. The default risk has two components, one is capital risk and the income risk, because it not only basically because it means not only the complete failure to pay, but also the delay in payment. Even if somebody is not paying, then the organization is prone to the default risk. If somebody is paying also, but they are delaying in payment, then also the default risk or the credit risk of that particular organization increases. So, because of that, we have to be very much concerned, the financial organizations, mostly banks, are very much concerned about the minimization of the credit risk, and that is why they want to choose the customers in such a way that where the probability of default for the repayment will be less, and by that they can minimize their credit risk in the system. Then we can come to another risk which is called the liquidity risk. Though in the true sense, what do we mean by the liquidity? The liquidity is basically what? How fast this particular asset can be converted into cash. If it is very easily, very cheaply can be converted into cash, we can say that that asset is more liquid. For example, if you say there is a check and there is a draft. So, obviously, if it is a check, the check is more liquid or draft is more liquid, or if you are holding that particular asset which can be easily convertible into cash, that is obviously more liquid. You have a savings deposit, at any point of time you can withdraw your money. So, that is a liquid instrument, but whenever you are investing in the stock, that may not be a liquid instrument, but you need certain process, certain kind of mechanism to liquidate that particular asset. So, because of that, there are certain kind of liquidity issues what always the financial institutions face in the system, Therefore, if you define the liquidity risk basically refers to a situation where it may not be possible to dispose of or sell the asset, or it may be possible to do so only at the great inconvenience and cost in terms of the money and time. You can sell off, you can liquidate, but it takes a lot of time, and as well as you are going to incur a lot of cost in terms of the transaction cost or the administrative cost. So, because of that we can say that this particular asset is less liquid. So, that is why liquidity is very important in terms of the investment or the financial market or financial system. So, the greater the uncertainty about time, price concession and transaction cost, greater the liquidity risk. Liquidity is a concern for the companies. The reason is, or for this any financial institutions, the reason is if the company or the financial institutions are not liquid, then what will happen? It is not liquid in the sense the transaction cost in the market is quite high. So, more the transaction cost, the liquidity will be less the transaction cost, liquidity will be high. So, that means the cost or investment or participation in the market is very costly. So, if you have to make your market more liquid, in that sense it implies that there is a reduction in the transaction cost or reduction in the administrative cost. So, this is what basically always we observe in the market whenever we define the liquidity risk in the system. So, here if you see that liquidity risk from a market perspective and liquidity risk from a bank perspective or other financial institution perspective is little bit different. Why it is different? Because already I told you that how liquidity risk is defined from the market perspective. From the market perspective, the liquidity risk is nothing but how easily that asset can be converted into cash, number one. Number two, how you can minimize your cost to participate or to invest in the market. If your cost is very low for participation, then obviously the liquidity risk is less. If the administrative cost or maybe this your transaction cost is quite high, then we can say the market is highly illiquid. In that sense, the liquidity risk is more. But whenever you talk about the banks, why the banks or any financial institutions need liquidity? Because they have to satisfy the customer's demand. The customer's demand is, for example, I have deposited my money in the bank. So, whenever I need, I should withdraw my money at the time of requirements. But for example, I went to the bank and I could not withdraw my money because bank has no cash available with them. Then what we can say? The bank is suffering from liquidity. That means bank has not enough cash which can cater the demand for the customers. So, in that context we can say the bank is illiquid. So, that creates some kind of disturbances in the market. You feel that the bank is going to be insolvent, then that leads to a liquidation and end of the day there is a failure. But here the question is that from the financial institution point of view, the liquidity means how the particular organizations are able to cater the demand for the depositors and whether the depositors are able to withdraw the money at the time of their requirement or not. But you remember, liquidity and profitability do not go together. If you want to keep more liquidity, profitability may be hampered. So, that thing we will be discussing more whenever we discuss more on about commercial banks. Then another type of risk we have the maturity risk. What do you mean by maturity risk? In financial system, we have the different type of assets. Some assets are short term maturity, some assets have long term maturity. But the question here is, as you know, that if you are holding a asset, there are two bonds. One bond's maturity period is 2 years, another bond's maturity period is 20 years. If somebody has invested in the 20 years bond, then obviously they are exposed to more risk, because they do not know what is going to happen in the long run. What should be the interest rate scenario, how the interest rate is going to be changed, how the policy is going to be changed, what kind of political stability we can observe, then all kinds of things will affect the discount rate, and if all these things will affect the discount rate, automatically what will happen, the price of the bond will be highly fluctuating. So, if the price of the bond will be highly fluctuating, then we are exposed to more price risk or the reinvestment risk. in that context what we are trying to say, because the future is uncertain, the prediction of the economic fundamentals are relatively uncertain. In that context, if somebody is investing for the long run and somebody is investing in the short run, the person who invests for the long run, they are exposed to more risk. Why? Because the forecasting and envisioning the environment, conditions and situations becomes more difficult in the long run. So, if the forecasting is not possible for 20 years, and how can I say that how the interest rate scenario will be there after 20 years? The interest rate may go up, the interest rate may go down, and the interest rate is also again depends upon certain other policy measures what these regulators and the monetary authorities are taking. So, all kind of things are going to affect my pricing of that particular asset. So, if the pricing of that asset gets affected due to the change in the discount rate, cash flow, etc., then what will happen, and I am exposed to more risk. But if somebody is investing for a short run basis, maybe 6 months, 1 year, it may be to some extent possible how this interest rate scenario is going to be and how this particular market is going to behave in the next year. So, in that context what will happen? It will be relatively easier for them or for any investor to say that how much risk they are going to be exposed and what kind of return they are going to get and what should be the price of that particular asset in that particular context. So, therefore, maturity risk is also important. We have to see that whenever you are investing or holding any kind of asset, whether the maturity period is long or maturity period is short. So, because of that the longer maturity assets have the yield of longer term maturity are more than the short term maturity assets. That is what basically you observe, but that yield may not be sufficient enough if you are exposed to more risk from the market point of view and as well as individual or unsystematic risk point of view. Then we have another type of risk which is called the call risk. You know what do you mean by the call risk? Let there is a bond, the bond has the maturity period, there is a bond, the bond has the maturity period for 10 years. I just simply example, but whenever you have issued the bond, let the coupon is 10% and the par value of the bond is rupees 1000. But generally what happens, there are certain bonds which are callable or the callable bonds or call bonds. So, in that case what we say, maybe there is a provision whenever the bond was issued, there is a provision after 5 years the company or the issuer who has issued this bond to you, they can call back the bond, they can call back the bond and there is a price fixed for that from the beginning. But you assume whenever the bond is called back by the issuer to you, from you, let the interest rate in that particular point of time in the market is very low. Then if you could have sold the bond in the market on your own, then you would have got a better price than whatever price the issuer is giving you. So, then what is happening? For example, that time you would have sold the bond in the market, you would have got 1200 rupees, but now the issuer is giving you 1100 rupees. That is fixed, you are bound because there is a provision in that. So, because of that you are exposed to that kind of risk. So, you cannot do anything with that. So, therefore, the call risk is associated with the corporate bonds which are issued with callback provisions or option whereby the issuer has the right of redeeming the bonds before their maturity. They can call back that bond, maturity period is 10 years, but the bond can be called back after 5 years at any point of time. So, that time the particular investor or bond holder who is investing in that bond, there may be exposed to more risk if the interest rate in the market is relatively low, and if the interest rate is relatively low, then he could have got a better price if he would have sold the bond in the market instead of giving back that bond to the issuer in that price which is already mentioned. That is why in case of such bond, the bond holders face the risk of giving up higher coupon bonds, reinvesting proceeds only at lower interest rates and incurring the cost and inconvenience of the reinvestment and also the price. There are two things what they are going to be exposed. So, either that time again if they are reissuing the bond, the coupon may be low, and again if the interest rate is low, they could have sold the bond in the higher price and they could not get the actual high return what they should be getting. So, because of that the Call risk is also one important type of risk always we face, mostly in the bond market or other financial derivatives market, etc. So, these are the different type of unsystematic risk always we face, and the investor always try to minimize this unsystematic risk to maximize the return. So, in the next class we will be talking about the different return concept, that how this return is basically calculated, what are the different concepts related to the return. Please go through this particular references for this particular session. Thank you very much.